Currently, the market is melting. Tariffs are here, and investors are panicking. But while most of the attention is on the drop, there's something else happening. Value stocks have been struggling, and growth stocks may quietly be setting up for a comeback. As Warren Buffett once said, be fearful when others are greedy, and greedy when others are fearful. Today, we're going to be covering 4 growth ETFs that offer long-term upside, and why this market panic may actually be a great time to pay attention. Welcome back to The Skilled Investor, where we break down market trends, smart strategies, and the tools to help you make your most informed decision with your own research. So here's what we're going to be covering today. First, we're going to take a look at what's causing the latest drop in the market. Then, why it might not be as bad as it seems. 4 top ETFs that give you exposure to growth, and how to combine them into a smart portfolio. Whether you're just getting started or you're already investing in the market weekly or monthly, this is for you. So let's start with what's going on first and foremost. You probably know this already, but in case you don't, last week President Trump just announced reciprocal tariffs to most countries, with numbers way higher than what most analysts were expecting. Specifically, he announced a 34% tariff on Chinese goods, which combined with existing tariffs, result in an effective rate of 54% on Chinese imports. The markets then immediately reacted. The S&P 500 dropped nearly 5% in a single session. Safe haven assets like bonds and gold spiked, and recession fears came roaring back. And it's not just tariffs either. We're also dealing with sticky inflation, high interest rates, and an growing uncertainty around the 2024 election. But here's the key insight. Markets, they don't need good news to rise. All they need is a little bit of certainty. If tariffs are reversed, or if an inflation cools faster than expected, we could see an upwards bounce. And if not, and if recession does arrive, the right ETFs can help you stay invested and weather the storm. So instead of trying to time the market, let's talk about owning it through diversified ETFs that can work across market cycles. Here are 4 of the most powerful ETFs for long-term growth and how each plays a different role in a strong portfolio. The first ETF is VTI. It's Vanguard's Total Stock Market Fund. It gives you exposure to over 3,500 companies across the full US stock market. It's got large caps, mid caps, small caps, tech, healthcare, energy, industrials, all in one fund. And why does this matter? You're not betting on one trend. You're not buying one single thing. You're buying an entire economy. This makes VTI a perfect foundation, especially in uncertain times when no one knows which sectors will lead next. Could we fall back into a recession? Maybe. Or the tariffs could get walked back and tech could rebound. We really just don't know. And that's why diversification matters, and VTI delivers it cheaply with an expense ratio of just 0.03% and a 10-year annual return of above 12%. It's simple, it's efficient, and long-term investors love it for this reason. Next up, we have SCHD, the Schwab US Dividend Equity ETF. This doesn't chase hype. It focuses on high-quality US companies with strong balance sheets and a consistent record of paying and raising dividends. Think of names like Coca-Cola, Pepsi, Cisco, and others. Right now, when the market feels fragile, that kind of reliability really matters. Dividends add stability to your returns, and SCHD offers around a 3.3% yield, which is really not bad when uncertainty is high. But it's really not just income. SCHD has delivered 10 to 11% average annual returns over the past decade, thanks to price appreciation on top of the dividends. Its rules-based strategy filters out weaker companies, and its expense ratio is only 0.06%. So in short, SCHD gives you quality, cash flow, and performance, all in one defensive ETF. If we do enter a slowdown or mild recession, SCHD will likely hold up better than other high volatility growth funds. ETF number 3 is QQQ, tracking the NASDAQ 100. This is your tech-focused growth engine. It holds the 100 largest non-financial companies listed on the NASDAQ. We're talking about Apple, Microsoft, Nvidia, Amazon, Meta, Google, they're all here. If you believe the next decade belongs to AI, to cloud, semiconductors, and software, QQQ gives you concentrated access to those areas. Now it's important to understand, QQQ is more volatile. When markets fall, tech usually falls harder. But when sentiment rebounds, QQQ often leads the charge. It returned about 25% in 2024 alone and has a 5 to 10 year annual average of 18 to 20%. Still, with that upside comes risk. If the Fed keeps rates high or grows lows further, QQQ will likely take a hit. That's why we don't recommend making it the core of your portfolio. QQQ should be a great satellite position, not the anchor, not the main thing in your portfolio. And finally, we have VOO, Vanguard's ETF tracking the S&P 500. This one holds the 500 largest public companies in the US. It's diversified across all sectors: tech, healthcare, financials, industrials, and more. VOO is the default ETF for many long-term investors, and that is for a good reason. It's broad, it's balanced, and historically, it's delivered consistent returns. About 13% per year over the last decade, with an ultra-low fee of 0.03%. If you want to build wealth over time without constantly watching the headlines, VOO is an excellent starting point. It performs well when the market rebounds, but it also holds up better than pure growth plays during dips, because it's backed by America's largest and most profitable companies. Now let's talk a little bit about how to use all of these ETFs together if that fits your portfolio. If you're building a beginner or intermediate portfolio, here's a possible starting point: VTI at 40%, VOO at 30%, SCHD 20%, and QQQ 10%. Again, is a satellite position, is a smaller position in your portfolio. And you can, of course, adjust this based on your risk and your tolerance. The key here is balance. You want growth, but you also want resilience, especially when markets get choppy. So really, what's the key takeaway here for this video? Markets are messy. We're facing uncertainty, tariffs, inflation, interest rates, and results of elections. But that doesn't mean that you should panic. It means you should focus on quality, diversification, and time in the market, not timing the market. The 4 ETFs we discussed, VTI, SCHD, QQQ, and VOO, each play a role, or should I say a smart role, in this plan. And if Buffett's quote still holds true, then now while others are fearful, may be the best time to stay invested or even getting a little greedy the smart way. That's it for this video, guys. Thank you so much for watching. And if this video helped you clarify any of these ETF strategies, please give it a like and subscribe for more weekly investing breakdowns. Also, please let me know in the comment section which ETF are you planning on buying right now. Do you think that the market will bounce back or will it crash deeper? Really, until next time, stay patient, stay invested, and stay smart.